working capital cap line are some of the examples of the ABL-driven side of our portfolio. And then finally, we have project financing. And this would be probably most thought of as the contract cap line, the working capital pilot, or the export working capital program. Again, we are giving lenders the option to deploy MARC in any of the scenarios that we laid out. And from left to right, from open revolving through project, the monitoring requirements increase as you go. From an open revolving line, you're looking at the working capital needs of the firm. It's an open line of credit. Fixed asset leverage, you have to understand and be mindful of the equity in the asset that you're levering. You have the borrowing base component, and then the project, similar to construction loan, where you're advancing on every individual aspect of the project. For a manufacturer, what that could look like is a capital equipment manufacturer who's producing a piece of machinery. It takes a year to build. It has multiple draws for materials and labor. That would be an example there. From a product positioning perspective, so I mentioned some of the similarities between MARC and SBA Express, and I've also talked a little bit about the WCP, or the working capital cap line. And ultimately, I tend to think of the MARC as a bridge between these two products. So SBA Express goes up to $500,000. The WCP, really the most monitoring kicks in around $1 million. I think the average WCP right now is about 1.2 million. So this graph demonstrates that the MARC can transition both of those spaces, can go all the way to 5, but ultimately some of the monitoring requirements might kick in, or the WCP might become a better solution north of $2 million. But again, you, the lender, have the option and opportunity to structure using MARC in any of these capacities. So immediately, when this program goes live on October 1st, if you have borrowers who are already in your pipeline, whether they're current clients or prospective, and you could immediately move those express loans into a MARC product and gain some additional flexibility, the ability to go north of $500,000, which is the program limit on SBA Express. Then I think you also have the opportunity with working capital pilot, with working capital cap line, or the export working capital program, to consider using that side of the SBA 7A portfolio to outfit your revolving solutions, build a toolkit of products that you can deploy to help your clients, whether they're manufacturers using MARC or any other small business out there. So from an overview perspective, this presentation is going to focus primarily on the revolving side of MARC. I did want to start with laying out the differences between a 7A working capital term loan and a MARC working capital term loan. So from a maturity, lender fee, and PLP designation, they're the same. Now, the underwriting and collateral is where there's a difference. And this is how, so if you're a 7A lender, you're focused on, say, the term side of working capital, there are some differences where MARC could be a better solution. Again, ultimately, we defer. We want to listen to your feedback. We want to give you the flexible tools to meet your clients' needs. But some of the differences are that MARC requires that one-to-one cash flow. That's really the governor on the program. Whereas the traditional 7A working capital term loan, you have a 1-1-5 historical or projected cash flow, and then a 1-to-1 on a global basis. So there is a difference there. And then collateral, the standard fully secured definition versus kind of the blanket, the lien on all assets of the firm, that being a subtle difference between the two. So this is a good reference slide if you are looking at a working capital term loan to a manufacturer. This hopefully helps you give you an idea where you could deploy MARC and where it might be an improvement upon 7A working capital term loans, but not necessarily required. So getting into the terms. Again, the maximum term period of 20 years on the revolving side, 10 on term, that you can structure, as a lender, you have an option to structure the revolving period for up to 10 years. You can allow for renewals. So you have a lot of flexibility on how you position that. But it is important that in a revolving term loan, that the lender has the ability to accelerate the amortization if the program rules aren't met during the review. And we're going to get into that as we go. From a collateral perspective, I touched on this as being one of the differences between a 7A working capital term loan. So it has to be secured with a lien on all the assets of the business. It includes title, equipment, real estate. There are some carve-outs for vehicles. And then on the trading assets, the accounts receivable and the inventory, the revolving lines must be secured with the trading assets. So if you're issuing a MARC line of credit, it has to be secured with receivables and inventory. You cannot use MARC as a supplemental line of credit on top of another line of credit. So it has to be in first position there. And then on term loans, we want to make sure that you have the option to either place the lien on it or not if you're going to be issuing a revolving line in conjunction with a MARC, a permanent working capital MARC loan. Now, I've touched on the fact that I think that the debt service coverage is a governor on the product, and this really is one of the main underwriting requirements of the program. So in order to qualify for a MARC loan, you have to maintain, the borrower has to demonstrate either historical cash flow at 1-to-1 or projected cash flow 1-to-1 within 2 years of approval. So you can look forward, you have some flexibility to use projections, or you can go 1-to-1 historically, but this again is one of the most aggressive aspects of the program and one that gives you a lot of flexibility in terms of structuring these transactions. The debt service on the MARC loan is based on the maximum repayment. So if you issue a revolving line, you have to assume the revolving line is fully advanced and then amortize that amount over a maximum of 10 years to qualify. And you do need to maintain, this is on a one global basis, so you do need a debt schedule to be able to perform that analysis. So using that example of $1 million loan, we're going to price it at prime plus 1, so we have 8.5. It's a revolving line, but we assume it's going to term out over the 10-year period, so they're using the maximum allowable repayment. And let's assume they have another loan with an annual debt service of $60,000. So based on the MARC alone, you have the 8.5%, 10-year annual debt service of $148,700. Now you combine that amount with the debt service for the other loan, and then this gives you the EBITDA that you need in order to qualify for the loan. So this is how you would get the required cash flow necessary to service the debt. Now that's on a historical or a projected basis. So you can either look backward or forward. So we have touched on the monitoring requirements of the program. And this is a new aspect that I want to spend some time on it. So within the MARC, that the lender, on a revolving basis, the lender has to perform a review within 24 months of approval. You can sync this up with your annual review process, but ultimately this review is part of the ongoing servicing of the loan to ensure that, or to allow the line to continue to revolve for another year. If the borrower does not meet the requirements, that's when you have to get into the term out period. And you of course, you have the choice to begin terming it out. And we require that the lender build into the documents an ability to execute this term out, whether that is a call period, whether that's an annual review and with a renewal. You as a lender have to ensure that you have the ability to accelerate amortization if the program rules aren't met. And here are the program rules. Specifically, what we're looking at here, the solvency of the borrower, so obviously a bankruptcy, but most importantly, the 1-to-1. Now, one important distinction, we talked about the 1-to-1 coverage during approval and underwriting. During the renewal process, we give you the flexibility to calculate cash flow based on the interest-only portion of the loan. So using that example I had earlier, the $1 million MARC loan, prime plus 1. So the borrower obtained the loan. They're now going into their first review. They now have a second loan, so you'll notice the debt service went up. So how do you calculate this? So first you look at the MARC. The interest-only portion on the maximum advance is $85,000. Adding in the additional debt gives you the debt service. You'd have to be at 1-to-1 in order to continue have the line revolve for the next year. The term out provision, mentioning that this is an important part of the program. This just, again, gives you the option to move it up. Since the MARC is a working capital program, the line of credit has to be used for working capital needs, not for fixed asset purchases. So if you discover that the borrower used it to purchase fixed assets, we do require you to term that portion out within 90 days of the discovery. And this is a very similar program. This is the same concept that's found in the working capital cap line as well. So on the annual review side, and as it relates to the fees that are allowed under the MARC, we have two categories of extraordinary servicing fees that are allowed under MARC. The first one, I'm going to refer to it as the annual review fee. And this is different because we're allowing up to 50 basis points on the face amount of the loan to be charged annually while it's revolving. So while you're required to review it within 24 months, you of course can review it earlier. You can review and review and assess this fee on an annual basis. Once a MARC loan is termed out, whether that's out of the gate or after a term out period, you can no longer charge this fee. But we recognize that the full amount of the balance, the full amount of loan is required to be serviced. Full review is required, so that's why we have this new category of fee. And then our standard, our traditional extraordinary servicing fee, up to 2%. And this is what's found in working capital cap line. And this can be assessed independently of your practices on assessing facility charges or extraordinary servicing fees. So again, 2% on the line is allowed, and when it's under an ABL base only. And for both categories, the annual review and the extraordinary servicing fee, we're granting a blanket waiver on the requirement to seek SBA's prior written approval. So we recognize that this is part of the program. It's built in from the beginning. We want to be responsive to the reality of underwriting and structuring and make sure that you don't have to come to us for approval. So there's a blanket waiver on that aspect of extraordinary servicing fees. Disbursements. Again, as I mentioned earlier, when I was going through the different buckets of options, we do give you flexibility on how you administer the loan. So it can be an open line of credit, it can be an asset base, and you have flexibility, including what we call availability cap, which say you wanted to ladder the availability over time, maybe $1 million in year one and $2 million in year two, restricting, you get a $2 million approval, but that it's only available up to $1 million in year one. You have that flexibility. Ultimately, again, this needs to be a flexible product for you to meet your manufacturer's needs. I do want to touch briefly on asset-based lending within it, and one of the interesting ways I think the MARC can be deployed. So it's a pretty run-of-the-mill borrowing base. You have 80% advance on receivables, 25 on raw and finished good inventory. Using the MARC, you can lean in, include a little bit higher advance rate on inventory, include some work in process, ultimately get more liquidity out to that manufacturer. What is something new under MARC would be that you have a growing manufacturer and you want to include a portion of permanent working capital. So you know that they're growing, you need them to have a little more liquidity than what a borrowing base might support. So you can build in this example, $500,000, and ultimately that allows the manufacturer to better leverage their assets, get more liquidity. And this can be really important for growing companies who might be adding new product lines, developing new products, constructing, capital expenditure, equipment that might take a little bit longer to build. So this gives you some more flexibility, and one of the more unique aspects of the MARC. From a servicing perspective, while we require annual reviews and we do have a clear term out, lenders have all the same flexibilities and requirements that are outlined in SOP 5057. So you still have those same options in terms of helping the borrower get back on track. So there's no difference between the MARC and a standard loan for that. So that is a quick primer on the program, and to my colleagues on the chat, just let us know what sort of questions we have. I'll go through some transaction examples now to give you some different ways to think about using the program. And then I want to open it up for some Q&A at the end. So first transaction here, let's take a look at a manufacturer in the tech space, and they're expanding. They're basically going through an expansion. They have to ramp up personnel and inventory, and ultimately they recognize that they have a cash flow shortfall, or a working capital shortfall, and they need some liquidity to help with that expansion. So to build their inventory, to bring on the personnel. That rapid expansion obviously has an impact on cash flow, and that's why I think the MARC comes in, again, using that flexible debt service coverage component. And the solution in this case is a $2 million MARC loan. And you can see that the debt service was satisfied in this example at 1.05 to 1. So that would be less than a standard 7A term loan. But again, as a lender, you like the business, you like the management, you like where they're going. This example is secured with all business assets, and then it's a 10-year term loan out of the gate. So this is starting with the term aspect, moving into the line of credit. So let's take a look at a metal fabricator. And they do see occasional shortfalls in inventory. They want to make sure they have a resilient inventory position so they can continue production and maybe even purchase in larger quantities to take advantage of discounts. So in this case, they have an existing $500,000 express loan that they're basically outgrowing. So the company's growing, they have more of an inventory need. They're seeing a shortfall. And in this case, the lender's taking a look and, well, they're at the end of what they can do with the Express program, or what could be done with an Express program, and starting to look at a larger line of credit. So $1.2 million revolving MARC loan. The collateral for this being all assets. Since it is a line of credit, it does require a lien on the receivables and inventory. And the lender's structuring this as a revolving loan using the maximum term. So 10 years revolving and then a 10-year repayment. They'll review the loan throughout the revolving period. In the event that they need to accelerate it, their documents allow them to do that. Now, let's take a look at a different angle. So same deal, same fabricator, except in this example, the lender chooses to use a borrowing base. So not required to. So this is, again, how the MARC can be deployed. Same scenario, two different ways, depending on your appetite, depending on their need. So in this example, they're using a borrowing base. Again, a lot of the availability on this is coming from that growing inventory position, which is historically where the SBA guaranteed lines of credit, I think, have the most application. So receivable only lines of credit, that's pretty standard asset-based lending. But if a borrower has a lot of inventory, including some WIP, which you see more commonly within the manufacturing space, the guarantee can really help the manufacturer, or the manufacturer, access more liquidity against that inventory, help the lender get comfortable with that. So in this case, this was that borrowing base example I gave earlier. The lender wants to include a permanent $500,000 to help them with their expansion and their growth. So it's a $2 million revolving line, has a permanent $500,000 of availability built in. Again, all assets, including receivables and inventory secured loan. Now they're using annual maturities. They still have to conform to the same max 20-year term, so it can revolve as an ABL-driven line for up to 10 years. And where I think the products position together is that you can envision this scenario: the company's growing, they're building their balance sheet. Maybe they can work their way off of that $500,000 of permanent working capital, and eventually migrate into something like a working capital pilot loan, because that's more of a standard asset base. The cost structure is annual compared to the standard 7A fee on the MARC loan. So the MARC can be an important component within that manufacturer's growth story. And as a lender, this gives you another tool to help you support them throughout their early growth stage. So finally, touch on the MARC and how it compare with WCP. Here's the final example. So metal stamper here, telecom and defense sectors. They do have a concentration, so they have a large single buyer. They're trying to diversify their customer base. They plan $1 million investment into a new product to get them in more into the medical sector, but they need working capital for that. So, they have a $1 million line of credit that they're outgrowing. Need a larger line to accommodate the upcoming sales. So here's an example of how the MARC can combine with other products. Now, in this example, I'm going to use a WCP, but it could be a conventional line just as easily. So from a credit consideration, you have a large concentration and a strong balance sheet, the modest debt service. And now, so the permanent working capital component is supported through the term loan, and then a $2.5 million revolving line of credit takes care of the ongoing working capital needs of the firm. So that's receivables and inventory, second on all assets, and then they're using annual renewals on the WCP. So, we've covered during this presentation the basics on MARC. So you'll notice the program is quite flexible. The appendix is published, so you can now review that. But I've also talked a fair amount about other products, whether that's the Express program that most people are very familiar with, to the working capital pilot, the Capline product, our export working capital program, kind of that toolkit of revolving line of credit solutions. We do have resources within the SBA who can help you manage these. So our network of finance managers within the Office of Manufacturing and Trade are available to assist you, and really they do specialize in all things working capital. both from a manufacturing and a domestic perspective, all the way through international trade and export financing. They're one team that really is available to work alongside you. So this presentation today is really designed to give you an overview on the program, a couple different examples of how you can deploy the MARC, but ultimately to connect you with the resources available at the agency to help you and your colleagues at your institution evaluate our products, see where they fit within your program offerings, and then where they can have value to your customers. And we have a QR code here, which you can take to directly connect to our the SBA website, where it has contact information for all the finance managers, and then some resources available on our website. But with that, that is a quick primer on the working cap or the MARC program. And I would like to open up for some questions now. So to my colleagues on the Q&A, I think we'll head over there.
Thanks, Dan. So we have several questions in the Q&A. One of them including is the one-to-one debt service coverage ratio based on the interest only during the revolving period or the anticipated term repayment period payment?
So during the initial approval of the loan, it's on the amortizing full amount of the loan. So in that earlier example, went with $1 million, and it was you would calculate it based on the $1 million balance amortizing over 10 years, not the interest only. During the ongoing review process to allow the loan to continue to revolve, that's where you can use interest only if you choose.
Okay. If we have a line of credit for a $5 million line with a client, can we refinance the line into a MARC LOC with SBA, give SBA the first lien on the AR and inventory and the second on the equipment and building?
Well, in that example, I think you have a $5 million exposure. So my question would be, what is kind of the advantage to the borrower from getting the MARC? Presuming it's conventional, you have a $5 million exposure. So in that example, I don't think it would be a good move to the MARC because there's no day one benefit to the borrower in that example. But should it come up, we're more than happy to have that conversation, and that's where the finance manager team can really help you evaluate options.
The next one here is to determine the proper line size. Should it be based on the cash flow of the company, or should we be using the advance rates on the account receivables, inventory, et cetera?
Well, I think you have both options. No matter what size of a loan you choose, you have to have the debt service to cover it. So, if you can afford from a debt service perspective, that $1 million example I used earlier, can't go get a $5 million line on that. The MARC, since it is not an asset-based product, it's not governed by, the availability in the borrowing base necessarily. So you could, in that case, you would need to look at both. The debt service is really what allows you to approve it. But say you have debt service that exceeds, maybe the borrowing base need, you have some flexibility there or what the borrowing base can support, you have some flexibility in putting that together because you can give them a slightly larger line if you're choosing to go, without a borrowing base, or that earlier example where you had that permanent working capital component. That's something that can only really be done under MARC. You could do that. So you have some flexibility, but ultimately you got to make sure you adhere to the debt service. Generally speaking, you can look at, the receivable and inventory turnover, their sales cycle, their cash conversion cycle. You can look at these factors to help educate or determine what is the right amount of a line. But ultimately, we're giving you a couple different options. And then, of course, if it is more of a pure borrowing-based driven line, I would also encourage you to consider the working capital pilot.
Good. Can the MARC term loan be used to purchase items like equipment that are needed to expand manufacturing capacity? No.
So the MARC term loan is for working capital only. So that CapEx that you would need, you could use a standard 7A term loan for that. But say you needed to fund the CapEx for that manufacturing firm So they, say they're adding a product line, and then needed some permanent working capital component. You could pair that along with a MARC working capital term loan or the revolving loan. But the CapEx component specifically, you can use 7A, you can use 504 for that.
Okay. So if we have an express line of credit for $150,000, can we refinance this into a MARC line of credit, replacing the express line of credit?
Still have to grow. So we do have the option. If it's same institution, you can submit a GP. But I think one of the questions will be: are we just transferring a MARC, an existing express loan, into a MARC, or are we increasing the loan? So in those situations, we can evaluate those. But those are submitted GP, not using PLP authority.
What are the advantages of a 10-year MARC term loan versus a regular 7A term loan?
Well, from the borrower's perspective, they're identical because you get the financing. But from the lender perspective, that side-by-side comparison early in the example, I think highlights that. I think from an approval perspective, the advantage within MARC has to do with approval. So it gives you some flexibility on debt service coverage, and it gives you some flexibility on collateral. But in general, they're obviously quite similar. MARC is part of the 7A suite, but those are going to be the two areas for the lender that you can they can be helpful. And I'd say debt service is probably the most significant of those two.
Okay, so we have several questions on collateral, and most of the questions are, can we take personal assets if there's a collateral shortfall?
Absolutely. So the rules here are the minimum requirements, not the maximum. So as a lender, if there are personal assets that help shore up that transaction, you are free to take those, and there's no restriction on that.
Can the term out period be shortened less than 10 years if the customer's cash flow can support the debt serviced?
Yes. Yeah. Again, I think you as a lender have that flexibility. If you want to consider less than a 10-year, again, 10 is the max. I think 10 years is helpful to, from a starting point or during underwriting. But if when you start thinking about permanent working capital, you might not, as a lender, want that to amortize over 10 years. So I think it's perfectly fine to look at shorter terms, and you have that flexibility.
So we've got a lot of questions in the Q&A, and we want to kind of wind it down, but I've got a real good one here. So if the AR and inventory are not already pledged on a separate line, are they required for a MARC term loan?
Well, it's a good one. I would be curious why they wouldn't be secured, or why, in that case, they wouldn't be. You wouldn't want to have them secured. So, leaving them unencumbered. If there was a specific, if you thought there was a line of credit or coming up, you could probably make an argument. But if you weren't forecasting a line for that business, I'd be curious why you wouldn't just take all assets and move on. So we require them. The specific requirement here is that we're allowing you to not encumber the receivables and inventory if they're going to go with line of credit. But if not, then I'd really want to know the reason why not. But I would say that we require the lien on all assets. And again, we give the flexibility not to require them when there's a line of credit. But a situation where you would not want to collateralize your loan, I think that could be challenging. And I would, I'm going to go with you should get all the assets that are available. If there's a line of credit, then we're going to give you the flexibility to move those assets to the revolver. But if it's just a term loan, then I would I'd take the full lien.
Another collateral question: is life insurance required on the term?
MARC follows all the 7A rules, so follow the same requirements.
Okay.
It was a good set of questions, and hypothetical questions on collateral can be challenging, but I'll use this as a final plug for the team of finance managers who can help you within an individual transaction. but also with evaluating products and hopefully building out a suite of working capital options for your customers.
Does the company have to demonstrate historical profitability?
Have to? No, you can use projections up to 24 months. And profitability being kind of a flexible term, you want to make sure that you have debt service. You have to get to the one-to-one debt service either historically or within 24 months of using projections. So if they don't have the historical cash flow, you can have sufficient debt service without having profitability, presuming that the manufacturer would have a lot of depreciation in there. But you still need the cash flow. So cash flow, either historical one-to-one or forward-looking within 24 months.
Okay. We've got several questions on community advantage lenders. So if a 7A community advantage lender has a $350,000 loan limit, are they also limited to that amount in the MARC loan?
They are. So MARC is part of 7A. Love to have our community advantage lenders participating in the program, but ultimately the limits that you have as a CA lender flow through to any of the 7A products you're using, including MARC.
Okay. And finally, are there any limits on R&D? So we've got several questions on research and development is considered speculative. Is a manufacturer developing a new product available to get the line of credit?
Well, you have the flexibility in terms of how you want to structure the permanent working capital to support it. I think it really comes down to that debt service requirement and how you're going to meet it. Yes, some R&D can be speculative. Some can be related to generating the next generation of a product. As a lender, I think this is where you really need to evaluate how you're structuring the loan and how you're using, in this case, a MARC. But how does the business repay the loan? If this is R&D and we hope this works, and if it doesn't work, then the company's going to fold. That's probably not a good use. However, if it's R&D to help, you have some cash flow and you're looking to finish developing another generation or another complementary product, and you can handle the debt service. In that case, it might be more. You might need to rely more on the historical side. You wouldn't want to do I would caution against R&D working capital on a projection-only basis, where if this doesn't work, then we can't repay the loan. I would say that's not prudent lending. But again, we want to give you the flexibility depending on the specific need of that manufacturer in this case.
All right. So we have one about controlled disbursements.
Okay.
If they're coming in so quickly, so we're gonna have to cut them off. But
it's like the lightning round. I have to really be on my toes here, Ross.
Yeah. So if we're using MARC, can we control the disbursements on a loan?
Yeah, you have the flexibility on that. And that, when I think controlled disbursement, I tend to think more project financing or a borrowing base. But you have that flexibility. I'll come up with a hypothetical on a hypothetical. We'll talk about the R&D piece, and say you want to meter out the working capital based on the progress of the R&D or the working capital supporting that. You have the option. Again, we want to be, the program at the core of the 7A program is prudent lending. So we want to make sure that you as a lender are underwriting this and just cognizant of the risk going in. But if you want to just control the disbursements, we're giving you a lot of flexibility on that. We're not mandating the borrowing base. Certainly, this probably is not intended to be a largely borrowing base driven facility, for example, but certainly giving you the option. And again, whether it's the metering of advances for a term loan or a loan that you approve at $2 million, but you only want $1 million available in year one, you have that option.
So Dan, we're kind of winding down here.
All right.
Does the one final question: will the MARC program also be used in the SBSS scoring system?
Well, that's a good question. I'd say on the term side, it is effectively a term loan. You start to get into more of the revolving sense. I think, especially if you start getting a larger revolving, I imagine some underwriting would be there, but you have to meet the debt service. So you can certainly score it, but you still have to show that you've underwritten the debt service component. So you can certainly use SPSS in the process, but that doesn't alleviate your need to test either the historical or projected coverage ratio.
So we've got like 90 questions in the last few minutes, and
oh man, we're gonna be here a while, Russ.
We can't go through every one of them, but if you've asked your question not anonymously, we'll be able to reply to it, and we'll work on getting a Q&A. Yeah.
So this is great, though. I'm happy to hear on a Friday that we have such strong attendance. We obviously got to hear from Associate Administrator Kimsey and then Deputy Administrator Briggs. Again, we will continue to take your feedback, take your questions. Probably we can reconvene another call. We'll talk a little bit more about MARC during the 7A Connect call next month. So obviously the questions you're giving us now, we want to respond to those. The feedback we receive is incredibly important to further improving our programs, and we will certainly cover some of the questions that you brought us today in during the next 7A Connect call. And obviously, if the program is of interest to you, I would strongly encourage you work with your local finance managers and also district office personnel to evaluate the program, and we look forward to your partnership on it.
All righty. Well, thank you, Dan. Thank you, Administrator Kimsey and Briggs, and we will conclude the call.
Thank you, Ross.
Thank you for attending.